Hello, everybody, and welcome to the broadcast. My name is Clay Malcolm with Advanta IRA, and I'm here today with Chris Rawley, founder and CEO of Harvest Returns, and we are going to be talking about investing in agriculture, which, as we all know these days in the COVID-19 pandemic, is an essential asset. And specifically, I will be talking a little bit about IRAs and how they can participate in this type of investment, and then Chris will get into his expertise. If you do have questions along the way, please feel free to type those into the question box on your console. Be happy to answer those at the end of the broadcast. And so type them in as they come to you, and if we cover it, then we cover it. But if not, then at the end we will answer any questions that you may have. So let's go ahead and get into this. This is me, obviously, Clay Malcolm. I have been in the self-directed IRA industry for about 9 years, and I'm actually a self-directed IRA investor as well. So I'm one of you, and I'm really looking forward to the information today. I've known Chris for a couple of years, and I know that he brings a great knowledge base to the equation, and so I'm interested to hear what he has to say, especially in these unusual times. If you have any questions about IRAs and having them invest in alternative assets, you've got my contact information there, and I'd be happy to talk to you. A little bit of a disclaimer to start. So all the information in the presentation is for education purposes only. At Advanta, we do not give any tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to talk to your financial team anytime that you're considering an investment for your IRA. It's one of the great advantages of self-directed IRAs that you can bring your existing financial team and friends and their expertises to bear when it comes to the assets that your IRA is going to purchase. And at Advanta, our part of the equation is very neutral. Our role is to provide the account, make sure that the bookkeeping and the administration is appropriate so that the account type gets to keep the tax advantages that are associated with it, whether it's traditional or Roth, and we'll talk about account types here in a moment. But our part of the equation, again, is really to just make sure that the account is in good standing so that you get to keep the tax advantages on the investments that you choose. And we've specialized in the bookkeeping and administration for assets that are outside the stock market. And that's what we'll be talking about today, of course. One of the things that is unusual about that bookkeeping is that it's pretty idiosyncratic. Everybody's investment is a little bit different. We handle a lot of different types of assets, and the bookkeeping for each of them is a little bit particular to that investment type. So from a customer service standpoint, that's you and me, the account holder, it's really important that you have a company, that you're working with a company that has experience, that understands the way that these alternative assets work, what the disbursements look like, what the receipts look like, and the bookkeeping that's associated with those. We have all of your non-invested cash in an FDIC insured bank account, so that if you're in between deals or you're just getting set to do your first deal, the cash that you have in your Advanta IRA is obviously FDIC insured. We've been in business for quite a while now, almost 20 years, and you can see that we've amassed thousands of clients, and we have about $1.3 billion of assets under management. Makes us kind of a medium-sized company in the space, so experienced enough to have dealt with a lot of the different aspects that come with this type of investing, but not so big that you can't get somebody on the phone and talk through a strategy or ask a question. We really try to focus on that ability for the account holder to get somebody on the phone. In fact, we assign a particular account manager to every account holder so that you have a go-to person who can answer any questions that you have. And if they don't, then they can go through the rest of the building, get the answer, and get back to you. But we want you to have a one-stop place to work with a person that you know. You have their extension and their email, so that when you do have questions or you want to run a scenario past us, that you have somebody that you know you can get a hold of. And as part of our philosophy as well, we're very big on education. So we do live events. We have a very deep video library. So if this presentation spurs some interest in something else for you, there's probably a pre-recorded video that we have that'll give you some more information about it if you want to dig deeper. Or obviously you can just call the office. And certainly we have a blog that keeps up with the current events and things like that. Again, our goal is to make sure that you're an informed investor and that you have the service that you need so that your account gets to perform at its maximum. All right, so a little bit of the nuts and bolts about what we're talking about here. I often use the analogy that the investment strategy in self-directed IRAs is really a match. So there are the account types themselves are tax tools, right? And all of these types of accounts that you see on your screen are or can be self-directed, quote unquote, meaning that you get to choose what the assets are that are going to be purchased and sold and things like that. You provide the strategy, you're the motive force behind the activity of the account. That's what makes it self-directed. But the account type stays the same. So traditional IRA, Roth, some people don't know that their health savings account can also do this type of investing. Solo 401ks, SEP IRAs, all these types of accounts can be self-directed, meaning that they can participate in these alternative assets, particularly what we're going to talk about today, obviously, is private equity, but all the asset types that the IRS allows. So the account types don't actually change. What really changes in your self-directed IRA at Advanta is that you get access to these alternative type of assets. And the assets, as I mentioned, that's a relatively voluminous list. There's a few of them here. Certainly real estate, residential or commercial. You see folks in tax liens, private lending, so lots of debt instruments are available. Precious metals is gold, silver, platinum, and palladium. Oil and gas, agriculture is what we're going to focus on today, and it is actually also private equity in this particular case, so we're going to meld those two together. Hedge funds, and this is really just, this is not an exhaustive list by any stretch of the imagination. One of the really cool things about self-directed IRA investing is that as long as it's not prohibited by the IRS, you actually can invest in almost anything that you have an expertise in your personal world. So you can bring your expertise and your financial team with you in terms of developing a strategy for your tax advantaged account to invest. Now, specifically, as we talk about private equity, the terminology sometimes gets a little convoluted and can be a little hard to follow, but what we're really talking about here is companies that are not publicly traded. One of the things that the characteristics of a non-publicly traded company or stock is that they don't have the same public disclosure rules. So these are private companies, they operate a little bit differently, and so you finding out about them can also be a little bit different. That is sometimes the stumbling block for folks. They would think, hey, I really like to invest in a private company, but how do I find them? Well, that's a little bit different thing because they're obviously not listed on these publicly traded security exchanges. But if you do know of a company that you believe in, or and that could be for business reasons, so you think that this particular business type is going to bloom, or it might also be according to the way that you view the world. So maybe you want to invest in green strategies, companies that work with green products and things like that. That is totally allowable from an IRS perspective. So your IRA can invest in that according to your agenda. And these companies, again, once you find them, they may be offering private stock or a percentage of ownership, but that is really what we're talking about in terms of private equity. So it's similar to investing in a publicly traded stock. It's just that the company itself has a slightly different operation due to the fact that they're not publicly traded. Sometimes people will invest in private companies and equity in funds. So a fund may be gathering investors to go out and participate in a particular company or several companies or things like that. So funds are available as well. Sometimes they're real estate funds. So let's say a fund gets put together and is going to go out and buy an apartment building. So you could be an investor in that fund, which is technically for us private equity, but the base operation is in real estate or something else. So funds can operate as kind of a collection point for investors and then go out and do business in the world. Lots of times I hear people talking about venture capital, and that term has such an interesting feel to it. It feels so exciting, right? So this is really your IRA's ability to venture out and find a company that may be very small now, but could grow to be a very large and lucrative investment. So this is the way that money gets put into play. As an IRA finds a private company or an offering like this and invests in it, and the returns come right back into your account, and they have that tax advantage of the account type. Discovering the opportunities, as I mentioned, that could be you finding the company directly. It might be somebody that you know that runs it, or an idea that your neighbor had, or something like that. But there are also places that give you a chance to look at various investments, like Harvest Returns does, and Chris will talk about that in his part of the presentation. But you can find a place that is a source for these types of investments as well. So that may be something to get you started in terms of looking for an investment that matches your needs and wants. And I put the Jobs Act up there because again, we're talking a little bit about vocabulary. It's the Jobs Act has brought the word crowdfunding into focus, and it got a lot of different meanings attached to it at one point or another. There are several structures that are allowed in or delineated in the Jobs Act. So the only reason I'm not going to go through them today, of course, but it is a good idea for investors to understand the different types of organizational elements that are in the different titles of the Jobs Act, because it could affect whether you can invest in that company or not. Because a lot of times the Jobs Act will say these people, you can have this many unaccredited investors and this many accredited investors and things like that. So there are some effects of the type of organizational structure that the private equity offering has. Some of it comes from the Jobs Act. So don't be daunted by the vocabulary, but find out the particulars of whatever it is that you're looking into. And in terms of evaluating things, possible investments that you might have, this is often a place where people want to do due diligence, but they're not entirely sure how they would do that. So as an idea of some of just a few of the things that you might keep in mind is, looking into the principal's experience. Do they have a track record? If so, what is it? Are there complaints about them on websites? And right, wrong, or indifferent, the web does have a lot of information about people. So distilling that information is obviously your job, but there's information to be had. So there is a way to find out about the people who are going to be running your company or fund that you're going to invest in. Evaluating the risk, obviously that can do with the industry, has to do with the industry, as well as the people that are running the fund or the company and what their aims are and that kind of thing. One of the things that's really important, I think, for a lot of investors is how are they going to find out how their money is being deployed? So is there transparency in reporting back to the investors? That may be something that's very important to you. So that's good to find out ahead of time before you actually invest your IRA in that particular investment. The returns, how much is an expected return, or what is the range of returns that are possible, and when? Certainly with IRA investors, there's a time element. Are you already taking required minimum distributions? Are you in your 30s and you don't need a lot of cash right away? Really, that has a lot to do with your personal financial world. So IRAs are just part of that. And so thinking about the return of the investment and the time length is really an important part of the strategy. And then exit strategy. So if you're in an investment, does it have a time limit? Does it not have a time limit? If it doesn't have a time limit, what are your abilities to get out of that investment if you wanted to? All those things are variables that you would that you might want to check into when you're thinking about an investment and whether it matches your goals and your desires. So this is just a little brief overview of some of the things to consider, but the idea is basically a very simple one. Your IRA has some money that you've contributed to it or have in there from a transfer or rollover. Often that's from an old 401k that where you no longer work for that employer, so you roll that over. You can fill out an application about 15 minutes, get your account started, fund that account, again, transfer, rollover, contribution, or some combination of those. And then at that point, you're just looking for an investment, and your account manager at Advanta will help you with the paperwork so that we can document that investment. So again, you get to keep the tax advantages. So it's really a pretty easy process from an IRA perspective. It's simply taking your investment strategy and using it with a tax advantaged account, with that tax advantaged money. Okay, so I'm going to once again encourage you to put questions in the question box. We'll answer those at the end of the presentation. And at this point, having that little IRA preview, I'm going to go ahead and turn it over to Chris Rawley, founder and CEO of Harvest Returns. And he is going to take you through the topic of the day, which is investing in agricultural investments. Chris, are you there?
I am. Hey, thanks, Clay. Hopefully everybody can see my screen here. Appreciate you joining us today to learn about this. As Clay say, it's an essential asset. And I wanted to start out by telling you a little bit about myself and why we started Harvest Returns and why we think that now more than ever, agriculture and agribusiness is a compelling investment opportunity. So way back when I joined the Navy after college, and as they say, I got to see the world. And as part of those travels, been to more than 50 countries and visited many war-torn war zones and very poverty-stricken countries. One thing that I noticed over the years was that people are very, outside the United States, people are very in touch with agriculture, and that's because they have to be. They don't always know where their next meal is coming from, and they're either growing it on their own property or buying it at a local market, living in a very rural area. And most of us up until very recently have taken agriculture for granted and food, and we think food magically appears on the grocery store shelves or in a restaurant. And I think COVID, right or wrong, is getting us to reevaluate those. So after I left active duty service, I spent some time as an investor in commercial real estate and technology. And one of the things with this newfound appreciation in agriculture I wanted to do was I decided I wanted to invest in a farm. This was several years ago. And it turns out that is a hard thing to do unless you have a lot of capital and a lot of knowledge and know-how, and you want to go out and buy a large piece of land and farm it yourself or hire somebody. It's just not an easy investment to access. On the other hand, from an institutional side, it's been a very appealing asset class. So university endowments, pension funds, large institutions, private equity firms have had exposure to agriculture and farmland in their portfolios for decades. And it's been very recently that the individual investor has been able to take advantage of these offerings. And that's why we started up Harvest Returns back in 2016 to make them available. So I want to talk a little bit about agriculture and, more importantly, the food system and how we see that changing very rapidly, especially these days, and how that affects potential investments in agriculture. So when I was growing up way back in the 1980s, I ate whatever my mom put in front of me, probably like many of you did. But now that has changed recently. Consumer preferences are rapidly evolving. You see that little word bubble up there. People like to eat. They like to know where their food is produced. They like to know what's in it. They like to even know who is producing it. And more we see that things like organic and naturally raised food is important, and local food, locally grown food is important, especially. And I'll talk more about that, why that particular trend is not only important from just a consumption perspective, but from an investment perspective. All right. So because agriculture is changing, consumer preferences are changing, food production methods are changing rapidly. So for example, most of the leafy greens and vegetables we eat in the United States, approximately 80% of them are produced in California. Well, that's interesting, and that you've got some very productive, fertile land with just the right amount of rainfall in places like Salinas Valley, California. But you've also, when you get some real good economies of scale by having migrant labor forces there and large scale production. The problem with it is that becomes a vulnerability when there's any sort of disruption to the supply chain, as we've recently seen. So what we're starting to see, and this is sort of a trend that started in Europe and the Middle East, is vertical agriculture production, vertical farms. You've probably heard of hydroponics or aquaponics. That's growing without soil or growing in conjunction with fish in the case of aquaponics. You'll hear a term that we use, the official term we like to use is controlled environment agriculture. And the reason this is important is because you can control the climate. So you can control produce in climate areas where you normally wouldn't do it, and produce it so it's closer to where it is actually consumed. So that means there's fewer what are termed food miles to get that food into the mouths of the consumer where it's going, whether it's going directly to a local farmer's market, directly to a restaurant, or directly to a small local distributor and then pushed out to consumers. There's a lot of advantages. This type of agriculture is very sustainable. It uses less water. There's no pesticide runoffs. The number of growing cycles, instead of having maybe one growing cycle per year, you can have 4 or 5 if you're growing certain types of vegetables. There's a significant advantage of this type of controlled environment agriculture. One of the disadvantages is it takes capital. So we talk to dozens of farmers every month, and many of these local vertical agriculture systems are starting up across the country to meet this local food demand, but they require capital because it's not cheap. You're not just taking a piece of land and planting some seeds. You have to build a controlled lighting and humidity and various types of growing systems. So that requires capital, and that's where the investment comes in. And at the same time, as Clay mentioned, COVID is getting us all to start thinking about, where does our food come from? I mean, for the first time in my life, I've seen empty shelves in the supermarket, at least here in the US, where the food is being produced, but in a lot of cases, in the cases of pork and the cases of milk, because there's no way to get it to the consumer, or the packing plants have closed, the processing plants have closed. It's unfortunately getting wasted and thrown away, and crops are getting mowed over, and the meat's not able to be processed. So that's why, and not to mention, just kind of initially during this pandemic, we had sort of runs on food. So we saw a lot of empty grocery store shelves for the first time, and we feel that getting a more varied and differentiated food system here in the US will make us all more secure from a food security standpoint. So I want to talk a little bit about why somebody would want to invest in agriculture. The first of all is demographics. Well, as everyone knows, the population of the world continues to increase. There's some projections that say we're going to have 10 billion people on the planet by 2050. And at the same time, when countries become more wealthy, populations become more wealthy, they consume more food and they consume more calories and more protein, especially. So this is a growing industry. Food has always been a growing industry, and it will continue to, the need for food and calories will continue to expand as the population expands here in the next decades. The second reason is simply because of returns. So that one little snapshot is just a slice of US farmland and an index compared against so S&P 500 stocks, AAA rated bonds, REITs, which is sort of your real estate. I know a lot of self-directed IRA investors are real estate oriented, and so am I, and have a background in that. And agriculture is simply just another form of real estate. Instead of having tenants, you have produce are your tenants. And then there's gold and just inflation itself. So that diversification piece is important. Agriculture and farming is non-correlated. It's a non-cyclical industry. So people, no matter how bad the recession gets, people are still going to have to eat, and that the prices may rise, but that's good. You know, if you're a holder in agriculture, you're going to, and I think the latest thing I saw yesterday was that food has inflated about 2.6% since this whole COVID started. So we are starting to see some inflation in food, even though maybe some other asset classes are being depressed, and it's non-correlated. So if you're looking for a hedge in your portfolio, if you've got exposure to the stock market, or you have bonds, or you have real estate and some of these other asset classes, that's great. Allocating some portion of your portfolio to agriculture is a way to sort of hedge corrections in other markets. And you know, people ask us, well, how much of my portfolio should I put in agriculture? And obviously that's up to you and your risk return profile. But you know, some of the professional institutional investors that invest in natural resources might allocate anywhere between, say, 5 and 15% of their portfolio in this class. And we've seen that might even be starting to grow in sort of a renewed interest in agriculture due to the pandemic here, not to mention the correction stock market. So when I talk about investing in agriculture, what does that mean? Well, it's a wide investment class, just as you might look at investing in real estate. There's notes, there's single family homes, there's multifamily homes, there's industrial, there's commercial buildings, there's all kinds of commercial real estate. Same thing with agriculture. And I'm just going to talk briefly about each of these sort of categories and the way we see them and what sort of the return risk profile looks like. So the first is timber. This is one that's very popular with institutional investors, where you've got just large tracts of timber. Good and bad of timber is very non-correlated. The trees are going to continue to grow over the long term. The returns can be as high as 15 to 20%. There's hardwood and softwood and all different kind of categories. And I would mention that if you want to learn more about sort of each of these classes, to check out our blog. We do have a lot of educational materials at Harvest Returns, but timber is a good one. It's hard to access in a small manner. So it's one that we don't deal with, although we have done tree crops, which is that next one, permanent crops. So these are things like orchards, also some more exotic things like cocoa trees. We've done some investments in those where the returns are really good, but they only grow in very specific climates outside the U.S. Livestock, despite all the things you hear about plant-based meat, people still eat a lot of meat, and what we are preferential to is grass-fed and humanely raised livestock. And the reason we like that grass-fed beef especially is because it's a premium product. So like a lot of premium products, it's not as affected by commodity swings. In our particular case, the beef producers we use smaller packaging and processing facilities, so they haven't been impacted by these big COVID-induced shutdowns. So we're big fans of livestock, and we've done some probably $2 million in debt instruments with grass-fed livestock private companies. Indoor agriculture, I talked a lot about that, but there's a wide range, and ranging from a small vertical farm and an industrial park. We did one of those in Dallas, Texas, to a very large scale, multi-acre, multi-greenhouse offering similar to the one in this picture in Kentucky, where they're producing large quantities of produce hydroponically to send to a regional distributor throughout the Midwest. Then there's row crops. So this is, many of you, depending on where you live, you live in the Midwest especially, you're going to drive through and just see miles and miles of corn or wheat or sorghum, or down here in Texas we have cotton. These row crops, they tend to be that's a lot of people think about that when they think of agriculture. They tend to be a fairly lower return, and they can be impacted by commodity prices. So we honestly at Harvest Returns, we don't do a lot with row crops, but there are some ways to invest in that asset class if you like to. The primary being is to actually own farmland, and if you're a farmer, great, but if not, most of the farmland owners in the U.S. are families, but they actually pay somebody else to do the farming for them. The last part we like as well is agribusinesses and processing facilities. That particular picture happens to be a hemp CBD processing facility that we've done, but as you see with COVID, it's not as simple as just growing the food. You've got to process it, package it, and get it to the consumer, whether it's to a restaurant or through a wholesale distributor, or now more and more we're seeing direct from farm to consumer sorts of business models, especially in the beef industry, and we like those. So there is just a wide variety of agriculture and agricultural investments. One of our mottos at Harvest Returns is we like to be the one-stop shop for investing in agriculture. So we try to provide something some type of investment that meets the risk return profile and goals of every type of investor. So that's really concludes my presentation. I'd be happy to either talk to you during this webinar, or take your questions and answer them now, or you can contact us, and I think Clay's going to put up the contact information. So I'll turn it back over to Clay.
Yeah, thank you, Chris. I appreciate it. And I'm going to go ahead and put up contact information for us. So yes, if you have questions, please feel free to type them in. We'll answer these during the webinar right now. But if you have questions beyond, or it takes a while for the question to appear in your head, please feel free to take down this information and give us a ring later. We're happy to answer any questions that you have. So let's go to the questions. First one, Chris, this one's for you. What are the returns in investing in agriculture?
Okay, great question. And like I said on that last slide, it depends. It depends on what you're investing in. If you're investing in row crops, you might see a 4 to 5% return per year, plus a depending on how the deal is structured, appreciation. It's going to equal 10 or 11% on an annual basis. Some of the permanent crops, tree crops, you might see north of 10%, 12, 15, 16%. And then something a little more speculative, where you're investing in a private agribusiness, like a processing facility, those returns could be north of 20 or 30 or 50% even. Obviously, there's risk associated in every investment, and private equity and private placements certainly have risks, just like investing in stock or real estate or whatever. We try to mitigate. We work very closely with our sponsors to mitigate that risk, so that it matches the return profile. And there's a lot of ways to mitigate risk in agriculture. One obvious way is with indoor agriculture. You've basically taken the weather out of the equation, and some of the pest infestations and things like that. But there's also insurance. There's commodity hedging of prices to mitigate against price risk. And then one of your best ways to mitigate risk, whether in any sort of private investment, is to have trust in the sponsor and find sponsors that know what they're doing and have a track record. And we try to vet our sponsors pretty heavily, and only a small percentage of the deals that come to us. And we talk to dozens of farmers every month. Only a small percent, probably less than 5%, actually make it onto our platform. So what you see are some of the best deals that have come across our table.
Something you just said actually touches on another question as well, Chris, is how do you select investments for harvest returns?
Yeah, so the farmers come to us. They start out, we have sort of an online form. They present us with a business plan and some numbers, and we do a very initial review of those. And then the ones that we sort of make it through that initial scrub, we will have conversations with. We'll secure into a contract to do due diligence with them, and then we'll start a due diligence process. And we're looking at several variables. One, like I said, is the sponsor. Have they grown? Not only are we looking for somebody who knows what they're doing from an agronomy standpoint, from a growing perspective, but we want somebody, and I say someone, but usually it's a team. The people that we like to work for have a team. The farm, it's great that we work with farmers, but if they've got a team of CPAs and attorneys and or financial people, that's even better, and vice versa. We talk to people that are more business savvy, but they've got a wonderful team of farmers and growers that work with them. So the first main criteria is the sponsor themselves. Have they done this before? What's their background? What's their track record? The second is the merits of the deal itself, and that could involve things like, are the cash flow projections realistic? So I've got a team, people that have experience not only in agriculture, but finance and financial projections. We want to make sure that the cash flow is not going to put an undue burden on the farmers that require payback our investors. We don't, generally we're doing equity, although we have done debt as well. So we want to make sure that these guys aren't over leveraged. And we're also, again, identifying all the risks, making sure the risks are disclosed, not only to us, but to our investors. And then the kind of the last aspect is there are sort of non-tangibles, things like sustainability. We like environmental sustainability and social sustainability. We like to see disadvantaged farmers having an opportunity to start their business or grow their business. And we like to be able to present those to investors so that they can feel connected to the food system and to the farmers themselves. And we provide updates from our farmers to our investors. And one of the criteria to work with Harvest Returns, if you're a sponsor, is you have to, no matter how small the investor is, they have to be able to come out and visit your farm if they'd like to. So we've had that happen as well.
Great, thank you for that. Some of these questions overlap, but I'm going to just read them and so we can kind of fill in the gaps.
Okay.
First one is accredited or non-accredited investors. So Chris,
Yeah, great question.
Yeah, on Harvest Returns, how's that look?
Yeah, so we do Regulation D, 506C, and 506B deal, and you know, I'm sure you've got some smart investors there. They kind of know what accredited, non-accredited means, but just a quick review: if you're accredited, it means you have over $1 million in investable assets, or if you're a single individual, I think it's $200,000 per year in income. But we do 506B deals as well, to which we can take a limited number of non-accredited investors with some certain criteria. So if you are non-accredited, but you've invested in private placements or real estate or whatever, maybe not ever agriculture, you know, look us up, send us an email, give us a call, and we'll talk. But there's a good chance you'll be able to invest in our deals. And I'm sure this is a question. I'll throw it out the answer. What's our minimum investment? Generally, our investment sizes to get into these start at $5,000 and go up to $25,000. That's kind of our range of investment sizes.
Great. Yeah, and you did hit one of those questions. Thank you for that. Next one. For those who know next to nothing about the investing in this asset class, how do you recommend getting started, and how can your company assist?
Sure. As I mentioned, we have some educational materials on the website. That the best place to go is you know, follow that link to harvestreturns.com. Click on our blog, and you'll see articles about just about every type of agriculture. We talk about agricultural risk. We talk about how the deals are structured. We talk about you know, trends in agriculture. So just doing a little reading is important. There's also our media link, and you can hear myself or Austin Manis talking on a variety of webinars, both investment webinars and farmer-oriented, agriculture-oriented webinars. And you know, you can pick up the phone and call us. We're a still pretty small company, and we like to talk to investors, and we like to talk to farmers. So feel free to shoot us an email or talk to us, and we'll kind of go through not just the you know, investment process, which was pretty easy and straightforward, but also you know, what these deals look like. And you know, get on the website and sort of browse some of the offerings, and you'll learn a lot. Each of them are presented in a similar way and structured fairly similarly, although we're talking everything that ranges from grass-fed beef in Georgia. We've done that, a couple of those offerings, to cocoa farm in Ghana. So we've got quite a wide variety of products on the website.
Great. Excellent. So next question is, what's the typical length of the investment and overall IRR?
Okay, great. So duration is an interesting question. Traditionally, agriculture has been a sort of fire and forget long-term investment, where you bought a piece of farmland and you held on it for 10 or 20 years or 2 or 3 generations. That's why it's been inaccessible for individual investors. You had to basically be a farmer or own farmland. So what we've done, based on sort of my investment experience and experience working in commercial real estate, is try to structure these more in a more familiar manner that someone who has invested in, say, a multifamily apartment complex or a single family resident might be familiar with in a private placement. So we've had deals that run as short as 4 months. We just had an exit out of a 6-month deal, up to 3 to 5 years. And IRRs, like I said, they can range from 8% up into the higher double digits if it's a one of our processing facilities.
Great. Is there a trend in terms of length of investment? Are some more popular than others, Chris? Some length?
Well, COVID has changed a lot of things for a lot of people, right? So what we've seen is people are looking for the shorter investments right now, just because there's so much uncertainty in the world, and we've got some 4 months to a year deals that people tend to like. But There's also some benefit in being in a little bit longer, 3 to 5 years, because you've got illiquidity, what I call the illiquidity premium, where it doesn't matter if the stock market's going up or down, the crops are continuing to grow, and sometimes it takes, especially with tree crops, it takes you a while to get your returns out of those investments, because you start out planting a sapling. And we've actually got a bamboo farm that we did last year, and he just planted, and in 2 or 3 years he's going to start harvesting that bamboo and getting the return, and then our investors will be exited out in 4 or 5 years. And the way we do exits, there's 2 or 3 different ways. One is just a cash flow. The cash flow from the offering enables the investors to get out there, targeted IRR in a certain period of time. Another would be where, in some of these greenhouse facilities, there's a lot of capital up front, where you spend that capital, the cash flows kind of trickle in, and then they grow larger and larger, and all of a sudden it's almost like a utility plant. Instead of putting out electricity, it's putting out, say, baby cucumbers, and those facilities can be refinanced or sold once they're up and running, and that's, so a merger or acquisition is another way that our investors see their money in a typical kind of cash out refinance, like you might see in real estate as well.
Interesting. So this may overlap a little bit, but which part of the agricultural investment is affected most as a result of COVID?
We've had some of our, I assume they mean negative, not positive. We have had some positive effects on some of our grass-fed beef guys, because there's such a huge demand for beef right now, and beef coming from smaller processes. So there's been a positive effect there. One negative has been some of the guys that are selling retail, and specifically hemp. Hemp is an interesting, very crop with a lot of momentum. It became legal in all 50 states in 2018, and a lot of money coming into it, a lot of people growing it. And we didn't focus on the agriculture side. We focused on the growing side. We focused on the value added processing and retailers. And one of those retailers has been hurt just because the CBD stores closed, but they're starting to open up as the country opens up. So I'd say that's probably our main negative that we've seen so far.
One person writes in, does Harvest Returns purchase or invest in agricultural properties?
So what we do is we don't own properties ourselves. However, we do take an interest in most of our deals, and I personally invest, in some of our other company owners invest in the deals themselves. But what we've done is we pool your investments, whether it's $5,000 or $10,000 or $100,000. We pool those into what's called a special purpose vehicle, and then we invest into these farms and agribusinesses as a single investor. And so we own an equity interest, although like I mentioned, we have done some debt deals where we take those investments, we pool them as a loan, and we loan those to the grass-fed cattle producers to purchase cattle.
Okay, great. Next question. Let's see. For investment through a non-qualified account, and that's going to let me out because my expertise is really the tax advantaged accounts. But for an investment through non-qualified account, what is the tax treatment? Ordinary income for regular returns, or cap gain for appreciation at exit?
It could be both. So if you're getting annual distributions, those are going to be ordinary income, and then at the exit, if there is a capital gain when the business is sold, there you'll see that. And the thing to know about agriculture, like real estate, you'll see when you get your K1 each year, and these investments do produce a K1. For those of you who are familiar with that tax document, you'll see some. What we all like to see is those the taxable returns are more than the tax recognized. So we get losses from depreciation, we get losses from some tax credits specific to agriculture, depending on which state you're in. And we've got an opportunity zone fund as well for people that have capital gains that they want to shield those gains. And so it varies, but in general, it's fairly comparable to, say, a commercial real estate deal.
And can you say a little bit more, just for those who may be kind of familiar with the term, but not necessarily with the details of the opportunity zone?
Sure. So in late December 2017, they passed the tax reform bill, which included this opportunity zone aspect. And what the opportunities, I think there's about 7,000 opportunity zones, and about half, 40% of those are in rural areas. And um, most of the opportunity zones are focused on sort of commercial real estate and disadvantaged areas. We're one of the few that are doing anything related to agriculture in our opportunity zone. So essentially what it allows you to do is take your capital gain from the sale of an asset. So that could be sale of stock, could be sale of a building, rental property, could private business, whatever you're seeing on a capital gains. It's somewhat like a 1031, but you don't have to roll it into a like asset. So you take that, and as long as you invest it within 180 days into an qualified opportunity zone fund, you're able to reduce the taxable amount depending on when you invested. If you invested before December 31st of 2019, I think you got I want to say it was like up to a 15% reduction in basis, but now if you invest, I think it's a 10% reduction. You don't have to pay taxes on those capital gains until December 31st, 2026, although I've heard Congress is toying around as part of the COVID stimulus of extending that date out. And then if you hold the investment in the fund for 10 years, you pay zero capital gains on the appreciation of the fund itself. So our opportunity zone is actually invested right now in a single asset in a vertical farm in Omaha, Nebraska. We're still taking investments. You do have to be an accredited investor. If anybody's interested in that, they can reach out to us.
Great. And there are some questions about for the specific offerings on your website. So what's the best way for folks to find out more details if they wanted to chat with you about those specifics? Where would they go?
Yeah, so there's a feature on the platform itself where you can ask a question in a specific deal. You just chat in, and we'll get you. We'll work with the sponsor and get you an answer as soon as we can. Or you can just hit us up at info@harvestreturns.com. Or call us on that number, and we'll be happy to answer whatever questions specific to the offerings you have.
Great. Next question: What are blue chip agriculture companies?
Blue chip agriculture companies. I'm not sure I understand that. If we're looking for, what it's best in class, I don't know. Maybe I need a little elaboration.
Yeah, there's a follow up here. The major players like Purdue and Tyson, maybe,
Oh,
or
yeah.
are there others?
Yeah, John Deere. If you're looking just to buy the stocks, you can do that. There's some farmland REITs as well. One is Farmland Partners. The other one is Gladstone. I've invested in those myself. I will say that one of the problems with those is you're investing in the stock market. So when the market takes a hit, it tends to doesn't matter what the asset class is, they all tend to take a dive. So yeah, those are a good way to get access to the asset class at a smaller amount. If you want to buy 10 shares of a stock, you can do that, or 100 shares, you can certainly do that.
Excellent. Thanks for that. Have you had any defaulted deals? If so, how do you manage those?
Thus far, no, we haven't.
Okay, that makes the question easy.
Yeah.
Cattle only, or pigs and sheep also, or anything else? Are there exclusions to what types of things you'll consider, Chris?
Wow, we get some crazy inquiries. We've had like snail farms and mushroom farms, and quite honestly, no, if they meet our criteria and we think it's going to be a good deal for our investors, we will certainly consider it. So nothing is the one thing that we don't do is marijuana, cannabis. Although we have, like I said, we do hemp. There's just too many regulatory things involved with doing cannabis. Plus, I think quite honestly that industry's a little bit hyped up, and the bubble already burst, honestly. So we'll do just about anything. And yes, sheep, we'll do sheep. We've talked to some pork producers and also some pork processing facilities. We'd like to see those get on the platform sooner or later.
Great. I've had a couple questions about people asking if this is recorded, and yes, the recording is ongoing and will be available to everybody who registered. So you'll receive an email a day or so later, tomorrow or the next day, that has a link to the recording, and it's also on Advanta IRA's YouTube page, YouTube channel, if you'd like to look there. It's always there. And it looks like it looks like we may have answered all the questions. So for those of you who wrote in questions, I did try to put some of them together, and if they were already answered, you may not have heard your specific question answered. But we will get back to you, and if you don't feel like you got an answer, please reach out to us as well. Happy to get you the information that you want. But at this point, we seem to be toward the end of the questions, and I appreciate everybody's time. And Chris, hey, thanks a lot for spending some time with us and giving us some insight into some of the things we've been hearing on the news and what you guys are doing over at Harvest Returns.
Yeah, Clay, thanks for having me. Yeah, and it's this is one of those things that, like I said, people don't think about until they have to, and now we have to, because you want to make sure that we've got food on the grocery stores and available for people to eat, and we need to keep our farmers working. That's the most important thing.
Right on. Yep. Okay. Thanks, Chris. Thanks everybody for joining us. I hope the rest of your day is a happy and safe one. And please feel free to tune into our educational webinars as they appear each week. And happy investing, everybody. Thanks for joining us.